Well, Dalal Street closed Friday on a somber note. However, the Nifty and the Sensex gained for the second straight week for the first time in 2 months. Now, in this week's edition of the Editor's Roundtable, we put the spotlight on Midcap IT's performance. We take stock of key budget expectations. We also understand the big railway opportunity for India. I'm Sonia. I have with me Prashant, Nimesh and Reema. So I was like choking on, on the fact that in less than 10 days you have the budget coming up. There's so much earnings hitting you. You're bound to choke, guys.
Sonia, by the way, has a interesting day lined up, right? Full of partying and etc. Right?
I will party with a Reliance PNL and Reema's going to be, partying with me, and the Geo numbers.
What time is it expected, though? I mean,
7:40. Historically, it's come at 7:40.
That's early, no? That's
Great
the person who never stayed back.
Friday, exactly.
But the week was such where I was just looking at the stats, right?
Yeah.
Nifty flat, mid-caps flat, non-index flat. I think the only thing that performed was IT, a tad bit because of good earnings. So it was one of those weeks where you want to call it perhaps the lull before the storm, you never know. But I guess all eyes will be on the budget and the big earnings.
And the earnings, right? I mean, the earnings this week kind of did not leave a good taste in the mouth because, I mean, earnings there were more downgrades than upgrades. I'll just quickly present a couple of things which I think is important to note as we kickstart the show. The Nifty still, by the way, is battling that range, same range, 400 points. The downside about 17,800 to about 18,200 on the upside. And it's been that way for 3 weeks, all 3 weeks of 2023 so far. On the downside, I mean, the 17,800 broadly, that level is important. I could get specific. The numbers will come up on your screen. We've been highlighting that. The December swing low, it's not been broken, thankfully. So maybe we sort of escape without further pressure, further cuts. Earnings is what I think is important to note. Consumer companies and so-called growth stocks, and I'll put out a piece later, they are seeing earnings downgrades coming through. I mean, over the last 48 hours, companies like Asian Paints, Havells, HUL for that matter, PVR, I would rate LTT as L&T Technology Services as a growth stock. You're seeing more downgrades than upgrades. I mean, actually, you would be hard-pressed to find where there are upgrades, meaningful upgrades at that, at all, anywhere in terms of the earnings stack that we've got this week so far. I think the baton in that sense of earnings once again falls on banking and financial services companies. Over the weekend, ICICI and Kotak will report. So we'll see if that can do something for the market. HDFC Bank could not, but ICICI and Kotak will report. That'll be important. Reliance, as we were discussing, is important. Last quarter, we saw a bit of a pause, but will we see a resumption of the quarter-on-quarter earnings growth for Reliance this time around? I think that's a big stock. 12% weight in the index could move things around. Lastly, from the global arena, it's mixed. I mean, it's not really giving a clear picture. But mind you, the S&P 500, the benchmark there, is at an important juncture. It's basically once again testing the downward sloping trend line all the way from the January 2021 all-time high, which has held through this year. Every time it goes to that level, we see a 7, 8, 10% kind of a pullback. 2 days in a row, the S&P pulled back. I mean, not much, by about 1.5%, 2% in aggregate. Is this the start of a fresh downtrend? Or, I mean, this time we finally take that out. I think those are bigger questions too. Keep your eye out on. Sonia.
I don't know if you guys feel that way, but there's this very tight range, right? Between 17,800 to 18,300. There seems to be no major cue which could take the market out of that range. And we have Pratik Agarwal joining us in this studio as well. Pratik, thank you so much for being with us on the show. Great to have you here. Prashant very helpfully put up all the stats for us. Do you think there's anything in these cues that could take the market out of the range?
No, so beginning of the year when we looked at the market, we thought on 1,000 ballpark 25 earnings, we should be 18.5 times. So 18.5 is the range that one should expect the market to be for this quarter, which will actually sort a lot of the issues that we may discuss going forward. But definitely think of this period as a period of consolidation. Maybe debt looks a tad better than equity. And hence I say 1 quarter of consolidation smoothens things well for equities. Now, in terms of what Prashant was saying, this quarter and maybe few more going forward is not about sales growth and sales growth led earnings growth. It is about margin increases. and margin increases will be seen more in manufacturing versus in banks versus in IT, etc. IT also will see some margin increase, but more in manufacturing, which is where I think some positive surprises would come.
Okay.
Sonia, so while you spoke about it, the market's been flagged, Nifty, Sensex, but for me the big takeaway was the fact that the FI selling has abated. Just 400 crores of FI selling this week. When have we seen the last, just 400 crores of selling from the FIs? Two reasons for that. One, last week, when I gave that update of big FI selling, it was largely because of one of the long-only FI was unwinding the India position. So that's largely done with. And to that, there was an ETF buying as well whole of this week. So that's actually, helped the FI number to a larger extent. So that's a big takeaway as far as the deal rooms are concerned. The other important thing is, while earnings are mixed, Prashant spoke about it, but the big trigger for from next week onwards will be that we are moving to T+1 settlement. All the large cap names, the blue chip stocks will shift to T+1. That would mean that the liquidity will improve. And I guess this is like a kind of an historic moment as far as India is concerned. So that's something to track. But largely, the big takeaway was the earnings are mixed. The Nifty has been flat, indices have been flat. But the fact that the FI selling has abated a lot, that's a bit of a positive sign as far as markets are concerned.
Okay, let me take that forward and talk a little bit about what happened this week. And we got a flurry of mid-cap IT names, right? The previous week was all about the large-cap IT names, but this week we had numbers coming in from Persistent, L&T Tech, Coforge, Cyient, Happiest Minds, so many of the smaller ones also reporting. The key takeaway is that the mid-cap IT performance was very divergent. The large-cap IT performance was consistent. HCL, TCS, Infi, all met expectations, did better. But in the case of IT earnings this time, Persistent, Coforge looked better than what the street was anticipating. And on the flip side, you had Emphasis and L&T disappointing. So the key takeaway is that the mid-cap IT performance is far more diverse. To elaborate on that point, L&T Tech downgraded its revenue guidance, but on the flip side, you had Coforge upgrading its guidance. So that's point number one. Unlike large caps, where the performance was consistent, mid-cap performance was far more divergent. The next point is, despite all the noise about macro uncertainty, slowing down on deal wins, slow decision making, the deal wins this time have been very strong, even for the companies which have missed expectations. Take a look at Emphasis. Emphasis was a miss in Q3 numbers. It was impacted by their mortgage business, but Emphasis' new deal wins were the second highest on record. Coforge reported its highest ever order intake in the current quarter. Now, the point is that typically when the external environment is far more uncertain, it's the large caps which generally have a steadier performance compared to the mid caps. And the reason is mid caps have a greater client concentration, a geographical concentration, or a vertical concentration. So if any of the drivers hit or if any of the legs misfire, then the stocks get impacted. In the case of Emphasis, for instance, they have a near 8-9% exposure to the mortgage business, right? Now that entire leg is not firing. In fact, it's declining for them. It saw a sequential decline of 20%. And that's the risk when it comes to mid-cap IT because they have a far higher concentration, either in top clients or in terms of specific verticals, unlike large caps, which have a more diversified base in terms of clients, geography, and even the kind of services that they offer. And that helps them tide through any kind of volatility in the macro environment. And one more final point, we were talking about valuations of mid-cap IT. Take a look at Persistent. Persistent is one of the most expensive mid-cap IT companies. Yet, on the back of good numbers, the street rewarded it. Persistent ends up with a gain of close to about 8% despite it being very expensive. So that's telling, right? That there is interest in IT, despite the high valuations for some of them, if the companies can give you the confidence that they can tide over this rough patch.
Let's ask the man next to you what he makes of IT. Pratik, any interest?
Actually, yes. So we at the house continue to be underweight IT, but versus the earlier level of underweight, we are now getting closer to where the index is, though still underweight. Now the point is, while there is uncertainty in the external environment, we have seen sharp cracks, and well, the whole debate is whether after the fall, post-COVID, will the growth rates fall back to pre-COVID levels? If they do, then the valuations are still higher. But if they sustain a tad higher, which is possible, then I think valuations are very sustainable. So we are nibbling there for sure. I take the point, the larger cap IT companies are steadier, but then larger cap IT companies are more order book driven, so more long period orders driven. less of shorter period orders. So the volatility in the smaller cap is also because they are shorter period order driven, which tend to be volatile. So and of course vertical. So if there are spaces which are doing well, open up trade.
Like mortgages, like we mentioned. I mean, that's
So
You've got to
those
be
spaces
selective
will
when
be-
it comes to
absolutely,
mid-caps.
absolutely.
Very selective
Very
mid-cap
selective, very
IT.
selective.
Well, the other big event, of course, is the budget that's right around the corner. Generally, it's a financial statement. We don't expect too many, developments on the budget day itself. But let's just put together a quick snapshot of what to expect. And then I want to toss the question to you, Prateek. Now, there are a couple of things. One, there's an extension of the corporate tax rebates for green manufacturing. And we do know that in this whole green manufacturing renewable space, Reliance has a huge investment that they've made, 75,000 crores. There are EV manufacturers as well, like Tata Motors, TVS, that could be in focus. Apart from that, everyone's expecting this to be an infra-heavy and capex-heavy budget. There's an expectation of a 15% rise in the budget spends on roads and railways. You've seen stocks like L&T at a fresh 52-week high as well, so that will be on our radar as well. Now, there could be a significant 20% boost to rural infra schemes. So this could be either housing for all or village roads, etc. This is in general positive for cement as well as for rural spending. And we have seen how up until now, a lot of the capex has been government driven. Now, the government is looking to broaden that to private-led capex as well. So, cement, metals, etc. could be in focus. Apart from that, rural spending schemes, NREGS could be positive for staples. So look out for names like HUL. There is a potential hike in the FPI limit in banks and insurance companies to 100% from 74% earlier. That could be positive for private banks as well as for insurers. So keep that in mind. A couple of other quick things. An insurance amendment bill that may address the composite licenses, the changes to the solvency issue, etc. And that could impact a lot of these insurers, whether it's SBI Life, HDFC Life. Tobacco taxation, we always talk about that. Up to a 5% increase is something that could be good for ITC, because if it's anything more than that, the street could take it negatively. Privatization candidates, names like IDBI Bank, Concord, Shipping Corp, BEML are in focus as well. Now, a point that of course is a bit tricky for the market is the indication of any kind of potential change to the capital gains tax regime. Jefferies put out a note where they say that there is a possibility of an increase in equities capital gains tax. There's a possibility of the change in the definition. Of course, it will be negative for the market if it comes through. But Prateek, from all of this that I stated, anything that you think could be market moving, sector or stock-wise?
No, so the budget should be an exercise in continuity. So globally, countries are focusing on building up infrastructure, building up capabilities internally. And I think same will be seen in India. It could be through extension of PLIs, it could be through, some tax benefits extended to one part of the industry and so on. But globally, building up domestic capabilities is the thought which is all pervasive. I don't think any of that surprises the market. I think on capital gains, I would be very hopeful. So equities are treated in a particular manner, debt and unlisted equity in a slightly different manner. I do hope that there will be convergence, towards equity. That is important because,
if it is convergence to debt.
Towards equity, because, globally, long and short-term equity is 1 year.
Yes.
Okay,
yes.
so if you go beyond that, you are diverging versus the globe. Now, that has implications on back offices, how people look at you and so on. And two, this is a period when, we need to put our best foot forward so that world looks as, and we need both debt and equity money is coming in and private equity. So in a period when, central banks are taking out money, M1 is going down, I think you need to just be that much more open and do everything possible to attract money.
You made the point of building capacity, and we're going to focus on building capacity in railways, right?
Yes.
Railway capex is a theme which the market is very excited about.
Prashant. So
Tell us more.
Sonia spoke about the key beneficiaries in the budget. Now we don't have a railway budget, right, so to speak, right? So of course there won't be much on the railway budget, but within the budget itself, there is going to be a lot of focus, I believe, on the railway side, and that's what I'm looking to put out a piece this week. So look at the Vande Bharat opportunity. That's going to be a big opportunity. We saw what happened to Siemens last week. That stock was up 10% on the back of a large order. It's the biggest biggest order that Siemens has bagged in their entire history of 26,000 crores. And not only that, they've also been the L1 bidders for 2 projects, the Surat and the Ahmedabad Metro project, and of course they are in partnership with RVNL, but they have a 65% stake there. And the order inflow of locomotives is going to be a key driver for Siemens and companies like that going forward. So how big is this opportunity is I'm looking at. So look at the big picture in the Vande Bharat itself. It's a 1.7 trillion opportunity from the recently floated tenders that we've seen. Now the initial tranche of 200 trains is an opportunity of 60,000 crores. That's kind of opportunity we are going to see in the railway. So who are the big beneficiaries of that? I've split into 2 halves. The first is the preferable players in the tier 1 players. That includes the names like Alstom, Medha, which is an unlisted company, and Siemens India. We already saw a big order for Siemens India. The tier 2 companies which are going to be component suppliers, they're the likes of ABB, CG Power, BHEL, and BEML. These are the few companies which are going to benefit. Now, I have further drilled down to the large, verticals within the Vande Bharat opportunity. The first one is where that accounts for the lion's share of 45%, which is called propulsion system. In that, the key beneficiaries are going to be Alstom, Medha, Siemens, BHEL, and CG Power. These are the 5 companies which are likely to benefit. The other big component within the Vande Bharat will be the rolling stock, which probably we call the wagons business. That's going to be another big segment which is going to benefit. And within that, the key players are Alstom, BEML, Titagar Wagon, Jupiter Wagon, and Texmaco. These are the 5 companies which are going to benefit from the rolling stock. So that's the opportunity for those companies. Now, apart from that, the next big trigger will be the another 200 trains of Vande Bharat, which are going to come up in the next few years. So that's going to be a big capex opportunity for all the railway companies. Now, if you look at what the railway minister spoke to CNBC-TV18 from Davos, I just quote him: the production of 80,000 wheels is a huge order for the Indian railway industry, and this is the kind of order which will give visibility for a lot of companies for a very long period of time. So that's the kind of opportunity which the railways are going to throw up. Now, who will benefit? I've just listed out the few names, but I guess while we don't have a railway budget now, but anything to do with the capex, and within that, the railway capex will be very important for the entire sector and for individual companies as well, that I pointed out in that piece.
Okay, Nimesh, thanks a lot for that. Pratik, how are you feeling about this space? Generally, we talk about it once a year. I don't know if it's given great returns to investors in the past. What is the prognosis like? Your thoughts?
No, so engineering is a wider space that we are focused on. It's an overweight position with the house. There are lots happening. So, the whole broad theme is we over time have seen reduction in manufacturing as a percentage of GDP. And through PLIs, through focus on renewable energies, railways, and the lot, we are seeing a reversal. And this time, happily, it is not like one sector, 2 sector led. It is across. So I think engineering companies, the space itself, practically everything should end up benefiting.
Okay, the big question we're asking: could Indian growth stocks continue to derate if the era of ultra low interest rates is firmly behind us? Prashant has moved to the big wall to explain more. Prashant, over to you.
The question we are asking is, do growth stocks need a bit of a reality check? Some would say it's already happening. Others would say more is required before they become more reasonable. Growth as defined by high valuations, high P multiples, because in many of these cases, and I'll present stocks later, market is given very high growth rates in perpetuity. Is that going to come under a bit of a reality check? I want to start with something macro, right? And this is interest rates, what I'm talking about. There are two knowns and one unknown. The 2 knowns are that global inflation is falling, is very clear. And at some point this year, interest rate hikes will stop. Global interest rates in the US, here in India, and everywhere else as well. The unknown is, once interest rate hikes stop, will rates be held high for very long periods of time, or will central banks once again cut rates to very low levels? And I think that is a $1 billion question, because equity valuations will depend on that a great deal. Now, 2 charts. One is the US 10-year government bond yield, all the way starting 1989 to where we are now. As you can see, a secular 3-decade decline, and now we've seen a bit of signs of life, right? And many believe that this has got more to go. This is not the end of it. The Indian government bond yield, the benchmark 10-year, is also back at where it was pre-COVID. I started this from January of 2019, and as you can see, we are almost back there as well. So interest rates, the point of this is, interest rates in that sense have normalized to a great degree. Now, why are we saying that maybe, just maybe, policymakers will follow a more sort of orthodox policy going forward, monetary policy going forward. We had negative real interest rates all the way from 2009 onwards to 2021 when rate hike started. Inflation shock was massive. Inflation is unpopular with central banks who are mandated to bring it under control. But of course, politicians hate it as well. And now with the sort of recent events of trying to get inflation under control via a big hammer of very sharp interest rate hikes, will central banks and policymakers allow rates to go back very quickly to very, very low levels? And that's the question we are asking. A more orthodox monetary policy, it's a big question mark. Now, low interest rates are important for equity valuations for two reasons. One, the market assumes low cost of capital for a long time, in some cases in perpetuity. And it also allows the market, as we are finding out now, to overlook potential risks to business models. Even risky, faulty business models were funded because money was cheap, which is not the case anymore. Two tables I'm going to put out now. One, large cap growth stocks, and the second is mid cap growth stocks. Now, this is not a comprehensive list, but just a sample to give you an idea of where we are at. The second column here is valuations 1 year forward in March of 2011. Where they got to just before COVID, March of 2019, and where they are now. This is all 1 year forward. As you can see, I'll just focus on the third and the fourth column here. Valuations are still, except maybe Siemens on this particular plate, much high. Siemens was trading at 37 times 1 year forward. Pre-COVID, it's at 60 times. You can see it for yourself for Asian Paints, Ambuja Cements, and other names will come up. HUL, for example, United Spirits, Avenue Supermarts. Titan perhaps is the only one here which has almost nearly come back and retraced to pre-COVID kind of levels. I'm not even getting into growth rates and projected growth rates. As we found out this week, a lot of these growth companies have seen a slowdown as well. Now, this is mid-cap growth stocks. Balkrishna Industries, Schaeffler, Havells, Page Industries, Volt. The only one here which perhaps is come back to pre-COVID is Page Industries, 52 times as compared to 54 times. And then you look at names like Voltas, Varun Beverages, Dr. Lal Pathlabs, Jubilant, L&T, etc. up on your screen. A similar kind of picture. These are well-run companies, leaders in some cases in their respective sectors. But that's not the point here. The point is, if rates don't go back to being very low, will they continue to put pressure on valuations going forward? And do these need to gradually come off a little bit more from here? Back to you.
To all our viewers, have a great weekend. Next week is going to be a hectic one. We're going to react to a lot of big earnings, Reliance, Kotak, ICICI Bank, and then we head into the big union budget. Keep it with CNBC TV 18. Thanks for watching.